Hello everyone, it's Uncle Bruce, and we are going to talk about dividends today. I've done a lot of work in reworking these dividends, and I've done some studies, and I think you're going to enjoy what happens with dividends. They really make a big difference in producing a good internal rate of return for the investor. That's what it's all about, folks. So, without further ado, let's look at what I did, because this is interesting. In this little section up here, we have three equity deals. One is without distribution, where we invest 160, exit year 7 with a multiple 3 times EBITDA. The adjustments are on and the case is high. So we've copied this by utilizing or using a drop down. You just click on the drop down and you can select it. So what we've done here is we've recorded what the internal rate of return will be for the founder and the investor. Because remember, this is an active model. It doesn't stop calculating. You throw something else in it, and it's going to change the internal rates of return. So you have to record it, and this is easier to record this way than writing it down, because you can actually print this. It's a nice little tool right here. So the next one is $160,000. Same amount, but this time we have a standard equity dividend. Goes forever. Again, the exit year 7, multiple 3, EBITDA. Adjustments on, high case. You see, everything's the same here, so I'm not going to bother reading it the third time because you guys can already read it. I know you're smart. So this one shows that we have a 76% founder internal rate of return by virtue of getting some dividends. And looky what happened to the investor. He went from 15% to 59%. Now that is significant. Remember, it's the same money, it's just being paid out earlier. In this first case, you wait the whole 7 years. At the very end, they distribute all that cash prorated to your stake in the company. Here they say, we got $500,000 sitting around. It's well above the amount that we need to run the company. Let's pay some out and increase the returns to the investor. Bingo! Look at this. Don't forget dividends, folks. They're very important. You may not have that giant company that does a billion or $5 billion worth of revenue, and you're going to be the next unicorn with $100 billion valuation. There's nothing wrong with a decent little company that puts out some good profits and pays its investors dividends. Watch for those cases. All right, so now let's look at the third one. Here, it's now $280,000 because we're engaged in the ED payback. That's that restaurant deal. And that required the hiring of a manager, somebody that's going to manage the build out and all the things you do to make that restaurant work. And he doesn't come cheap. In this case, I think it was $60,000 or $80,000 we're paying him. So you had to raise a little more money from this to get to this in order to pay him. So that's going to adjust your returns, but it's still interesting to see what happens. Okay. You know what's going on there. And here we have the founder at 64%, down a little bit from 76. And instead of 59, we now have 45. The reason these two are not as big as these is simply we had to raise more money. Profits are very much the same, but it cost us more to do them. We have to have money to pay a person that we didn't have to have in here or in here. Now, this is also just showing your liquidity ratio. This is live. Whatever you do, you'll see it moving. And it's equipped with the colors. Green is good, pink is worrisome, and yellow is, well, we got a little problem maybe developing. So here's the beginning cash in thousands, and here's the ending cash in thousands. So you can see what's going on here. Don't forget, if you change the amount of money raised, you must rebalance the balance sheet in Section F. Remember that. It doesn't affect the returns, it just looks silly to have an out-of-balance sheet. So, let's go down and actually do one of these things. So, now we're in the Section K, and this little section above here in the yellow has to do with dividends. You see, we can turn the dividends on and off, and if they're on, it tells you where to zero the dividends in case you want to, but this little switch does it automatically for you. In other words, you can keep the amount of dividend that you think you want for the equity dividend case, and you can turn them off. Just to prove that we're smart, watch this. We're turning them off. Off. Yep, did you see that move here? Off, on, off, on. So that's nice to be able to turn them off and on. All right, so now we're going to do the equity dividend. That's just a plain old dividend. So now let's take a look at what we have to do. Okay, remember we have to go to $260,000 for the equity deal. No, I'm wrong. The ED dividend is only $160,000. There we go. And we got a second button here which increments by 10. All right, so let's set this to be the $160,000. There we go. And let's set all of these to be the same way. There we go. I think that's the same. 2,000,007. This has to change. Remember, these little drop downs record what's going on. They're very handy. 15, 13. I got to change that guy there. Yep, there we go. And yeah, we got to change him. All right. So that's our ED dividend deal. And it's, we got to change this too. Sorry. All right. What we have here is we're looking at dividends. When we have them off, we don't see any dividends. If you happen to see them and you're still working the equity deal, make sure you turn those dividends off. Okay? All right, so that's basically what we got. Now let's go and do an equity dividend. All right, to do that, of course, we must go back up to the equity dividend, up here in section H. And we've already recalled our dividends, and we can see that it's not too far off, but we need to probably make them even better because we're going to look at this line right here, equity surplus. We can keep paying that down until it's almost zero. Now, it's not showing, and the question is why is it not showing? So we want to come back here. Oh, it's because the dividends were turned off. We're trying to do an equity dividend. You have to have the dividends turned on. So let's go back up to this section here. Let's move this little guy over here because we don't need to have him right where we're looking. All right, so look, we have equity surplus of 3,200. I think it ought to be a little bit more than that. Okay, stay at 13. Now here we got 64. Let's pay out some of that. Let's get it down to about 14. Here we got 65,000. Let's pay out a little bit more of that. You don't want to go below because that's a Ponzi scheme. Remember that. So we keep on going. There we go. Okay, and one more. There we go. So we're going to pay out dividends. Let's scroll down and see how many dividends we're actually paying out, because it'll tell you. Okay, so right there, $1.488 million worth of dividends, folks. That's a pretty nice dividend throughout the period of time. So look at the difference. You see, we got 59.4 versus 15.3. Yep. Well, we already showed that before, but this is where you're doing it, right down in here. All right, now let's go in and do an equity payback. Dividends are on. Let's go back up to the section. Now I see a bunch of pink here, so what I think I ought to do is I ought to just zero these guys out to make sure we're not paying out dividends until we know what we're really doing. So let's come up here. Set up the development management fee. Well, we have two ways of doing it, either the flat fee or, see, if we go to one, it's a percentage of gross revenue, and here's the percentage of gross revenue based upon this number here. Or if we go to zero, there we go, zero, it turns off the royalty and then it takes the flat fee and lays it right in here. So let's stick with the flat fee because I don't know about you. If I got a percentage gross of $2,300 for 1 year of work, I wouldn't show up. And you wouldn't either. Now, if somebody gave me $60,000 and I could work a couple days a week, yeah, maybe I might do that. That's not a lot of money, but hey, I'm going to own some of this restaurant, so maybe it would be worth my time. And think of all that good for free food I'd get. Yeah, I like free food, and being a restaurant deal, boy, you get a lot of free food, especially if it's a barbecue place. Yum, yum. All right, so let's set it back to zero, and there's our $60,000. Great. Now let's come down here and see how much we could actually send out. Again, we're looking at this line here. This is the equity surplus. You can go down until it goes to zero. So I'm going to come in here and I'm going to crank. I'll stick at 15. I'm going to crank again. See, it's just whittling it down. whittling it down. Come on. It's coming. It's coming. Okay. There it is, 18. Do the same thing over here. All we're doing is we're basically chewing up potential cash for dividends. And the charts are going and moving and being happy, and we're going over here, do the same thing. Now, yeah, you got a little negative here, but that's the distributions affects the next year cash. So it's kind of like at the beginning, you know you're making money during the middle of the year, so I wouldn't worry too much about that. At least keep on sending out dividends. We'll get it down to about 25, and then we'll stop. Every 24 is good enough. And again, we're looking right at this number right there, okay? And this is the amount that we're sending out. So we're coming down. It's almost there. We're going to go about 30. There you go. So now we've just set up the dividends. And now let's go down and take a quick look. ED payback. Dividends. Yep, here's the 55.6%. Everything looks good. So let's do the last one. Well, that is the last one. That is ED payback. So we got that. So I want to show you one more part of this section here. When you scroll over here, these are actually some areas where they're active. I put them off to the side so we have more room here, but you can read a little bit more. Where there's a blank here, depending on what you got over here, it'll come up with some bullet points. It makes good reading, and you should do it. Here we have a very nice table, summary of total returns to stakeholders. And I like it because you can go through and see what the different deals are, and you can see the money that's coming in and out. You can test the high, low, or mid. Now remember, you may have changed the dividends for the high, mid, or the low. So you play with this one here, and you better readjust your dividends. We don't have any way of saving 3 scenarios of dividends without using Visual Basic, and we're not using Visual Basic in this. I know how to write Visual very well, but this tool I want to have work on Macintoshes without any downloads and installation of Visual Basic packs or any of that stuff. So this is all pure Excel. All right, and then of course, you know, you can see what happens in the various year. I like watching this. This is a little fun to play with. A lot of information in this concentrated section right here. It's great to watch. Okay, you know that we all have the equity deal. Well, watch what happens when we turn it into an ED dividend. You see it all changed. And a payback dividend. So this is the latest investment summary that includes things like dividends and royalties and payback royalties and combo deals. When you use the section like this up in the very first deal making area, it's only for that. So don't go up there and copy that if you've done things like dividends or royalties. All right, come on down here, and here's our capitalization table to reflect all the latest changes. If you just stop at an equity deal, then you utilize what you have upstairs. If you need more, you come on down and you utilize these tables. Now, this section O here, summary of founder shares and pre-money options. It includes the founder cash call and dividend stream, if any. A lot of early stage investors want to know how much are they going to get at the exit. And if they've been asked to pony up more money because of a cash call, they want to see that too. This table here will tell you all of that. You even have the ability to turn on and off the adjustments. You can see they make a significant difference, about $400,000. And this is, of course, the same type of table for the pre-money options. We didn't have, but I think just one. Now, the real biggie is coming up. No matter what you do, you are going to use Section P.